Can you answer the two most important questions on Wall Street right now? When will the Fed raise interest rates? And how can I make money as a result? I've got answers to both. I'm Skylar James. Welcome back to the channel. I have leveraged ETF ideas that will outperform the market as interest rates rise. When will rates rise? It doesn't matter if you're already invested in financial stocks. A quick housekeeping item: what are financial stocks? Think first and foremost companies that make loans, so banking. But you also have insurance, brokerages, money management. It's a rather broad term with an index that has strong performance. There are several reasons why we should be evaluating the financial sectors and considering leveraged ETFs in this space. Warning, of course, these are advanced investment tactics and not suitable for everyone. There are three leveraged bull ETFs in this space. First is ticker FAS, and that's a 3X financials issued by Direxion with an expense ratio of 99 basis points and 3.6 billion in AUM. Second ETF is ticker UYG. That's a 2X financials from ProShares. Comes with a slightly lower expense ratio of 95 basis points and has $1 billion in AUM. And ETF number 3 is more specialized, covering just regional banks, not big banks, not investing houses. The ticker is DPST with 500 million in AUM and carries with it the highest expense ratio of the trio at 101 basis points. I don't want you to focus on regional banks though. I think they're too specialized. Investing in regional banks is a very niche tactic that most of us don't understand well enough to get right. Focus instead on the other two ETFs, FAS and UYG. They offer investors leverage to the big pillars of finance, names like Berkshire, JP Morgan, Citibank, and BlackRock. Every time I'm considering a leveraged ETF, I use the same approach. I ask the same three questions. What are the tailwinds? Is it a good investment outside of leveraged ETFs? And how much volatility will us investors need to stomach? It's that first question that's the most insightful, the one that teaches us the most. It's very simple. Why make this investment? What are the macroeconomic tailwinds pushing this sector or niche higher, so high that I should use leveraged ETF to capture those gains? Remember, we're looking at financial stocks as the way to profit from rising interest rates. If you think inflation is coming, then interest rates have to be following soon as a way to tamp down that inflation. That brings both good and bad repercussions for investors as rates rise, but ultimately, rates should only rise while piggybacking on a strong economy. For financial institutions, this limits lending risk as borrowers are more likely to be able to pay off their debt. Strong economy equals stronger earnings. It also means better banks earn a better yield on low-risk investments made by their clients' idle cash. Insurance companies call this the float, investing premiums before paying out claims. Now, for investors at large, we know that rising interest rates can be like a grenade in the market, causing volatility to spike. This too benefits financial stocks. Investors are more likely to seek out the professional guidance of Goldman Sachs and Morgan Stanley in the hope of beating market volatility. Think about institutions that have capital preservation as their hallmark initiative, like pension funds and sovereign wealth funds. Volatility also drives increased revenue from stock trading, people moving in and out of positions either due to speculation or, again, the capital preservation piece. As a whole, these are all great for financial stocks. 5 or 6 mechanisms to drive sector profits from rising interest rates. Speaking of mechanisms, pressing that like button is just that. It's a mechanism to let me and YouTube know you like this kind of content and want others to see it. So I'd appreciate if you could help this channel out. Let me throw out a wild card for right now. What about the rise of decentralized finance, predominantly through crypto? And what about companies like Square and PayPal taking a more prominent role in traditional banking? To me, the status quo of traditional banking is threatened, and I'm not alone in this thinking. Mizuho said buying Square today is like buying JP Morgan in 1871. This is a changing of the guard 150 years in the making. Square and PayPal have a combined market cap of $400 billion. These aren't small threats to banking. They're barracudas, and there's one specific way financials ETF can outmaneuver these barracudas? Stay with me and I'll get to that in just a bit. So wrapping up this question about leverage ETFs, there are short and medium term tailwinds, but for me, there are concerns on the horizon as we look out further. If you want a fuller list of companies threatening to take share from traditional financials, I suggest glancing at the holdings of ARKF and FinX. They're two ETFs covering emerging financial technology. I'll put links in the video description down below. And that brings us to our second question regarding the underlying index of the leveraged ETFs. So would you hold an unleveraged position of the same stocks or the same ETF? To help answer that question, I'd say that financial sector has had strong returns recently, they have moderate volatility, and they come with higher than average dividends. And this leads us into the third question we posed evaluating leveraged ETFs. If you're looking to hold one of these leveraged ETFs long term, do you have the stomach to not sell during the deepest of market downturns? Because remember, 3x up equals 3x down, and that's why leveraged ETFs aren't for everyone. Selling at the bottom is a surefire way to lock in your capital losses, and you'll need an iron stomach to hang on. FAS lost 83% of its value in the COVID crash. UIG lost 66%. Selling at the bottom, there would have been a mistake, but that's only easy to see in hindsight. So be sure to answer the question if you can hang on through the downturns. For me, the answer is no, not for the long term, because I don't want that volatility combined with what I see as the looming changes to the financial landscape. Remember, the markets are forward-looking mechanisms. Investors might head for the exits before I do, and I might be stuck holding 3x of the bag as they sell. FAS and UIG are, for me, more suited as short to medium term investments, 1 to 3 years. Now, there's one very important saving grace for financials. This is what I mentioned earlier about these emerging fintech companies being barracudas. These ETFs, FAS and UIG, are covering the financial sector as defined by their underlying indexes, right? So this isn't really a question of banks versus Square or banks versus PayPal. This is a question of the holdings inside the financial sector index. What sector a stock falls in is, believe it or not, kind of arbitrary. You couldn't make a case that Square and PayPal being financials, but they're largely considered to be tech. Now that could change at any time. So if fintech stocks start entering the financials ETF, then I would be more interested in the likes of FAS and UIG for the long haul. To me, this would be more indicative of the competitive makeup of the future-looking financials sector. What are your thoughts on the financial sector in the near, medium, and long term? Let me know in the comments below. And if you're into ETF or leveraged ETF investing, check out one of my other playlists right here. Thanks for watching, and I'll see you on the next one.